Yes, we're going to take a look at Roth conversion. So the first scenario I'm going to show you is if you're investing your IRA and your Roth IRA with different target rates of return in a level tax environment, how does that all calculate out? And we're going to do this two ways. The first one is taking two IRAs of equal value, growing them at 7% for 10 years. The tax bracket stays at 25%. So we're assuming today it's 25, 10 years from now it's 25%. With that growth over that time period, that 7% growth runs due to a high of $393,000. Now, we do have tax due, so we got about $98,000 worth of taxes due. So your net rate of return, in other words, after taxes, is $295,000. Not so bad, right? Well, if we apply some advanced strategies to this and we look at it from a Roth standpoint, let's see how the numbers will actually play out. Same scenario until you look at the conversion. So we're going to convert one of the two IRAs, pay the 25% tax up front, and then we're also going to change the rate of return for the location of the assets. In other words, the IRA, fully taxable, we're going to lower that return to 5%. The Roth account, fully tax-free, the one that we want to grow faster, is going to be at 9.5%. Now, we're still going to average 7% as a whole. So with a level tax bracket, this is how the numbers play out. By year 10, we have a total of $364,000, almost $365,000. Now, the tax due on it is only $44,000. And you might say, well, that's an awful lot, but we only had to pay tax on the IRA, not the Roth, because we already got that out of the way. And as you can see, 10 years later, the Roth account is greater than the IRA account. And the after-tax value ends up at $320,000. Okay, that looks pretty good, right? I mean, it's a lot more than what you would have had if you just maintained the two IRAs. Right. And you can see here the increase is about $25,000. This didn't increase any risk. The average rate of return was still the same, but it was the after-tax dollars that made the difference here. You ended up giving less to Uncle Sam. Now, let's look at scenario 2, rising future tax rates. So now everything stays the same, except 10 years later, the taxes rose to 35%. So now let's look at the math again. You run it for 10 years, it grows to the same amount, $393,000, but at 35% bracket now, you're paying out almost $138,000 in taxes. So your net rate of return is now $255,000 and change. So let's look at doing the Roth conversion. We're going to apply it in the same scenario here. So after that 10 years, again, the IRA is growing at 5%, Roth at 9.5%, but the average is 7%. Only thing that has changed is the bracket at the end when we pull the money out. It's now 35%. And the total tax due at this point is only $62,000 and change. So your net rate of return ends up at $302,000. How does that shake out? Well, it's now over a $46,000 difference. That is not chump change there. That is a lot of money. That's buying a new car. Well, maybe 3/4 of a new car.
Yeah.
And in 10 years, maybe a half a car. But you've got more money to apply to it.
Yeah, you only have to buy 2 more wheels.
Yeah, so it's really interesting. When you start applying the advanced planning strategies, it just makes a world of difference in the amount that you get to keep.